Hi, everyone. This is Jason Burek with Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I like to get his insights on the oil and natural gas markets every couple months. He's a former senior executive at Hess Oil for many years. He also is the president of the Energy Prospectus Group in Texas. He covers a lot of small and medium-sized oil and natural gas companies, also income plays like pipeline companies, master limited partnerships. Dan Steffens, thank you for joining me again.
All right. Thanks for having me.
So, Dan, we're recording this interview on Friday, May 10th, 2024. West Texas intermediate oil prices are kind of range bound around $78. The natural gas price, the US natural gas price, it was very, very weak the last 6 to 8 months. I think it got as low on the futures contract at about $1.60 around there. It's substantially rallied in the last couple of weeks up to $2.25. Before we talk about maybe natural gas and how that's affecting oil production in the Permian, we can get your thoughts on the oil supply and demand picture and with OPEC production cuts. Do you think that OPEC will extend the production cuts throughout all of 2024 now?
My guess would be that they do. We are heading into a period of higher demand. I just was reading a report today from Standard Charter, and they think that we're going to see some pretty significant draws from storage across the OECD countries during May and June, and they think that that's going to get the price of oil back over WTI over 80 and maybe push Brent all the way up to 90 again. We've had this little pullback, and the volatility in the oil market is definitely going to continue. There's just a lot of noise going on. There's concerns over the Chinese economy, and on Thursday, yesterday, some data showed that China actually increased crude oil imports in April, signaling an improved demand, and they are the world's top crude oil importer. We're also still importing. I saw in last week's EIA report, we imported like 7 million barrels a day. And our refinery throughput has started to pick up. That's been a concern to me that our refining should be well over 90, and to keep up with demand for summer blend gasolines, they have to ramp up to about 95% to keep up with that. So they're going to get going there. And U.S. commercial crude oil inventories are 3% below the 5-year average, gasoline 2% below the 5-year average, and distillate is 7% below the 5-year average. So our inventories are tight, and and remember the 5-year average includes COVID period. So, but it looks like demand is going to start picking up here as the kids get out of school. Here it usually does. So if that happens, I think it'll be okay. And then obviously, like you said, the natural gas price is going to really help. A lot of the companies that I follow produce oil, natural gas, and NGLs. So it's the mix matters. But then you got the situation in the Middle East. Israel is going to proceed with this invasion of Rafah, and who knows, what that's going to stir up. Maybe force Iran or Hezbollah or somebody to attack them more. So that's a very volatile situation, and it's always on the mind of the traders. I wouldn't want to be shorting oil with what's going on in the Middle East.
And let me add to your points there about the surprise number for Chinese oil demand. It actually increased by over 5%, and it looks like airline traffic is starting to return. So a lot of Chinese are flying to different cities in mainland China for either business or vacations again. So we're starting to see the numbers come back, because during the pandemic, that number, it flatlined, it totally collapsed. But now the numbers, it appears, are starting to come back.
Oh, yeah. And every time I get on a plane, every seat's full. So I think demand for jet fuel here is going to definitely be high. So,
oh, you mean in the U.S.? Because I was speaking about China, because the demand
China,
numbers.
No, I'm saying I agree with you on China, but I think we're going to also, our jet fuel demand is going to remain fairly high.
I want to get your thoughts on the Energy Information Administration. This estimate number was off by 800,000 barrels. I interviewed Christine Guerrero about a month ago about it. Is this ridiculous how you have a government agency trying to make oil production estimates and then they revise the number downwards by so much? Are you surprised that this stuff happens?
They got a tough job because, there's not a gauge on every oil, well in the country. We've got 1 million oil wells producing, so it's really hard to know. But they're constantly revising their numbers. And I think there's some bias. I know there's bias in IEA. They're definitely biased to, downplay demand for oil. But the EIA short-term energy outlook that came out on May the 7th was actually pretty bullish, if you ask me. They were forecasting that Brent would average 90 in the back of the year, which would mean $85 for WTI. Now they go on to 2025 and say that it's going to go back down to 80, but still at those prices, these upstream companies in the U.S. are really making quite a bit of money as well cost. Completed well costs have really come down because the rig rate is so low.
And you also said that in that report that they had coal prices relatively high. Yep. I'm kind of shocked that the Biden administration, the political appointees in the Department of Energy and wherever the other information was compiled would actually allow those types of bullish reports on fossil fuel energy to come out.
Yeah, we're using less coal for power generation, but you get to Asia, we're exporting a lot of our coal because it's really the only thing that can be affordably used. I mean, coal is the cheapest way to generate electricity, only here in the United States, because we do have the world's lowest natural gas prices. That natural gas can compete with coal in the U.S. just because we have such low. So we're just blessed with such an abundance of natural gas. So it really makes a lot of sense, and it's the only thing that I see that's going to be able to meet this rising demand for electricity that you and I have been talking about. It's just an incredible amount of electricity demand coming up in the near future.
Well, I also like nuclear power and uranium, but the problem is it's not cheap and efficient to build a nuclear power plant. Like China can crank out, I think, a coal-fired power plant. They can build a new one and have it done very, very fast. I think they have a new one come online each week, although I think they've been installing clean coal technology, the scrubbers into old ones, upgrading those, and the newer coal-fired power plants all have the clean coal. But I mean, the coal demand, shockingly, despite all these like ESG, anti-fossil fuel, anti-coal policies from the US and European Union, coal demand by end of 2023, it actually set an all-time high, but that demand increase, it was all from like China, India, and Asia.
Right. Yeah. Yep. Because we've shut down a lot of coal-fired power plants.
And it's still cheaper for Asian countries to import coal than to pay for liquefied natural gas?
Yeah, I think so. Because, our gas price, it's now, I think, like $2.25 today, which is, about 50 cents higher than it was a couple of weeks ago. But still, that compares to, gas prices in Europe and Asia in the $8, $9, $10 range. Because outside of the U.S. and Canada, pretty much natural gas trades in relation to the energy content that it has with oil. So, it takes 6 MCF of natural gas about to equal the energy in a barrel of oil. So natural gas, I've been in the industry long enough. I remember when almost always natural gas was within 6, 8, 6 or a sixth or an eighth or a tenth of what the oil price was. So, here when we're at $80 oil, we should be at like a $10 or $12 gas price on energy content. I don't see that happening anytime soon, but sooner or later, as we get more export capacity, our gas price will start moving toward the world price. We've just had these 2 extremely mild winters in a row that has left us with a big surplus of gas and storage, which has depressed our gas price. But it looks like it's turning around. We got LNG export facilities coming online here, 3 big ones in the next 12 months that should rebalance the U.S. gas market. So,
and the U.S. is also blessed with an abundance of natural gas supply. I think we have the most reserves right now, or at least the most production increases. And we have so much in the early phases of the shale bubble, they had to flare it. I mean, now with the new legislation, they can't do that anywhere near the levels. In your opinion, though, with low natural gas prices, even though we've had the rally the last couple of weeks up to $2.25 instead of $1.60, and I think at one point, Dan, near some of the wellheads in the Permian in Oklahoma, I think the price it was below $1. Do you think that?
Yeah, some of them when you added in their gathering and processing fees, they had negative gas prices, because some of them, their contract with the people that gather their gas is their net of those processing fees. So yeah, I had several. Riley Exploration reported its gas price was a negative 55 cents or something. But they drill the wells for oil, so they don't. To them, natural gas, if they can get anything for it, that's just a plus, because they make their money off selling oil.
That's interesting. Although I think Christine Guerrero also said that over the last like 4 or 5 years, that a lot more of the wells that are drilled in the Permian and specific basins are starting to have a much higher percentage of natural gas. I think she said 30% or more,
Yep.
and the numbers
Yep.
increasing
Yep.
now.
Yeah, every quarter I look, and I would say about 80% of the companies that I follow, their gas to oil ratio is increasing, because that's what happens. You know, these shale wells, you drill them for oil, but as you deplete them, the oil production starts drifting lower, and the gas production as a percentage of the BOEs coming out of that well, that increases. Now there's a ton of gas in the Permian Basin, and it's the gas pressure. It's that pressure from the gas that forces the oil out too. But as you deplete those wells, then you get more and more gas feeding through to the well, coming to the surface. Now, something that a little company I follow, Riley Exploration, they have formed a partnership with a power company based in Houston, and they are building on-site power generation where they can use the gas. Instead of selling their gas for 10 cents or 50 cents or at a loss, they're going to use it to generate their electricity for the fields, for their oil fields. So they can right size these things to match the electricity demand of individual oil fields. And so where now they're paying, high prices for electricity. And the problem is in West Texas, which is in some of these areas, you're out in the middle of nowhere, literally in the middle of the nowhere. And they have power outages, weather-related power outages all the time. And a lot of these have electric pumps in them at the bottom, submersible pumps in them that run on electricity. And they have a wire going all the way down to that pump. But if they lose electricity, that well shuts down, it can be very expensive to bring that well back online. Plus, the production that they use. So with this new thing, and I've heard that even big companies like Diamondback and stuff are really looking into this. So this could be a new business line. But for your listeners, you might take a listen and look at Riley Exploration Company. Riley Exploration Permian is the official example. Symbol of the company is REPX. But they talk about that, and they were real bullish on the conference call about the concept.
Is that technology, is it patented? Is there intellectual property that like a larger oil producer or a oil supply company, an oil service company would want to buy for the technology and the intellectual property?
Yeah, I heard about it a couple years ago at an energy conference, and I thought, hey, this makes a lot of sense. Why the hell? Why don't the oil companies use their own gas? You have to bring it, you have to clean it up, you have to dehydrate it. You can't be, pumping a bunch of water vapor and stuff through this plant. But so there's some cleanup that has to be done. But instead of, you're just giving away your gas because there's, not enough demand and not enough pipeline takeaway capacity. You're just giving it away. Or worst case scenario, you have to shut in your wells because you can't flow the gas. And so it's a big deal. And I think it's, because the Delaware Basin, which is the western part of the Permian Basin, is very remote. And a lot of times the companies have to wait quite a bit of time to get the electricity company to bring electricity out to their well site. So,
yeah, there seems to be an infrastructure problem in that part of the Permian and other parts, the new parts that they're drilling. There's a lack of pipelines there too for natural gas pipelines to move the gas to the liquefied natural gas export facilities or to other storage facilities right now. So I think there's definitely a growth and investment opportunity for the pipeline companies like ONEOK, Energy Transfer Partners, Enbridge, and Plains All America.
Oh yeah, definitely there is.
Yeah, so I think like ONEOK has a pipeline under construction now for that to move that cheap natural gas that you said to a more expensive so they can get a higher price at a liquefied natural gas export facility. So I think that's a good growth scenario for a lot of those pipeline companies.
Yeah, ONEOK and Plains All American are both inside of our high yield income portfolio, and I rate them as like A++ for safety. Those are super strong companies. They've been around for a long time. And when their pipes are full, and believe me, their pipes are full out there. And as long as they're full, they are generating a lot of cash flow. Because the pipeline business stuff, the CapEx is all up front. And once you get the pipelines in place, they are just money machines.
Yeah, it's like a toll road. You're just collecting. The oil company, the exploration production companies paying the fees to move the oil or the natural gas or the natural gas liquids through the pipeline.
Yeah, and for your listeners, Plains All American has got an interesting concept. You can buy their general partner. It's Plains general. The symbol is PAGP for the general partner, and you get the exact same dividend that you get on the MLP. The MLP is PAA. You get a slightly higher dividend there, but a lot of people don't want to mess around with an MLP for income tax purposes. You can get the exact same dividend by buying the general partner stock, which is PAGP.
Okay, the general partner stock, that's a C corporation. So that did the transition years ago to what Kinder Morgan did. So it's a C corporation, and people don't have to get a K-1 form for a master limited partnership filed with their tax accountants when they do their taxes.
Yeah, that's right. And if you put too much of MLP investment into an IRA, that can cause you some problems too. So, I have nothing against MLPs. I mean, if you're going to, take the extra time to do the tax reporting stuff, that's okay. You can actually get a little bit higher yield by going the MLP route.
Well, I would argue that the MLPs, when they were initially changed, I think in the 1980s under President Ronald Reagan, I think that allowed for a lot of extra investment into oil and natural gas industry, and that's why the U.S. has the largest pipeline network in the world.
Yeah, yep. They are better suited for the pipeline companies are perfectly suited for MLPs. Just because, all the capex up front, and then they just generate a lot of solid cash flow for dividends so they can maintain their dividends. Well, upstream companies that got into the MLP, that's not a good fit. I don't think upstream companies are a good fit for MLPs.
So I want to ask you about the low natural gas prices. If we stay at these levels, or we go range bound or go lower, do you think that the lower natural gas prices in the Permian Basin will start to slow down oil production growth going forward now?
It could a little bit, but I mean, they'll work around it because they're making so much money off the oil wells. I will say I looked at the strip today. The front month contract, which is the June NYMEX contract, closed today at $2.25, which is about a 50% increase in the last 30 days. Or not 50, a 50-cent increase in about the last 30 days. It was about $1.75. But the December 24 contract, which will be the front month in November, it closed today at $3.44. And I looked at the strip for 2025, and a lot of the months in the back end in the second half of 2025 are over $4 already. So the futures market is telling us that they see a much tighter market out a few months. There are 3 big LNG export facilities coming online. The first one is going to be in Plaquemines County, Louisiana. It's Venture Global, I think, is the one in that, and it's coming online here in just the next couple months, and it's going to add 2 billion cubic feet a day of additional export capacity. And another thing you're helping to gas, the Freeport LNG export facility is now all back online, so it's ramping up to full capacity right now. And I've heard that LNG prices in Europe and Asia especially in Europe, are going back up because they're wanting to totally cut off Russia, I think.
And I think Germany just announced too that they're going to be focusing more on building liquefied natural gas import facilities for power generation for cheaper electricity over building a lot of new nuclear power plants. I think that's the latest over the last week or two out of Germany.
Yeah, it should. I've just brought up the European. It's the Dutch TTF. Natural gas price was $9.77. So, there's a huge profit margin in being able to get LNG to Europe. And in Japan, it's called the Japan Korea marker, the JKM price, and it's $10.46. So it's now back over $10. So natural gas is the clean fossil fuel, and really the only solution to this worldwide increase in electricity demand that we see on the horizon.
That's a really big spread, right? If the oil and natural gas producer can get the natural gas through a pipeline to the liquefied natural gas export facility and then get a much higher price in Europe or Asia.
Yeah. Another thing that's going to happen as the natural gas physical market starts to tighten again, when you get the big price spikes, and we just, it was only a couple of years ago, we saw $9 gas. In mid 2022, there was $9 gas in August. You can get price wars, bidding wars going for supply between the utility companies that bring gas to your home or business and the LNG exporters. And the LNG exporters, they'll almost pay any price. The sky's the limit for them because the profit margin. I mean, if they have to pay $5 for gas, they don't care because they're going to sell it over in Europe for $9 or $10, and it costs maybe $2 an MCF to freeze it, to liquefy it, and then to ship it over overseas. So there's still a big profit margin in this business, and the prices will just be passed on to Europe and Asia is what will happen.
It sounds like the liquefied natural gas export facilities like in Texas or Louisiana, sounds like they should invest in more pipelines so that natural gas from the Permian can be moved to their facilities so they can sell even more at a higher price in other countries.
Yeah, some of them have. The problem with pipeline getting approval for them is such a pain in the neck. And how long has this Mountain Valley Pipeline in West Virginia been, trying to get that thing finished? And it's, you got governments are against these things like crazy. So it's crazy. It's crazy what our government's doing. They should be supporting this industry like crazy. It would help our balance of trade. And that's really a big deal too. So.
Yeah, that's a good point. I mean, Joe Manchin, the former senator from West Virginia, I think like in exchange for his vote, he was trying to for the Green New Deal, or not Green New Deal, for whatever Senate omnibus bill for emergency government funding to prevent a shutdown. He was trying to sneak in a vote approval for the pipeline, and then people found out, and there was huge backlash publicly.
Yeah. Well, EQT, which was the biggest natural gas producer in the country, they are merging with the company that controls the Mountain Valley Pipeline. That should close by the end of this year, and it's going to create quite a powerhouse of a company. So if you're bullish on natural gas, take a look at EQT Corp, and it's a very, very large company. One of my favorites. Let's see, look here, with a market cap of $17 billion. Very profitable. They had a real good hedging program, so they're actually free cash flow positive this year, even with the low prices.
How many years out are they hedged? Are they hedged with a lot of their natural gas production for 12 months, 18 months, 24 months? How long are their hedges?
Yeah, probably well into 2025. They have a hedging program. They're always like, 3 or 4, 5 or 6 quarters ahead of it all the time. And then, because they believe that gas prices are going to go up, they're going to do more and more of their hedging with collars instead of just swaps. So they, put in a floor and a ceiling that's really high.
And you've talked in past interviews about low-cost natural gas producers, like Antero Resources, and then also the company that Jerry Jones merged a couple other producers with.
Yeah, now Comstock, they really screwed up by not hedging. Comstock Resources was Jerry Jones' company. They should have hedged like 75% of their gas. Now they hedged about 25% at over $3, so they're doing okay. But Jerry Jones has had to put an additional $200 million to keep that company going. But they do have massive gas reserves, and they are a Haynesville, East Texas company, and they do have direct access to these LNG exporters. So if things tighten up as everybody expects, and the LNG exporters ramp up, and we get gas prices back $3.50 or $4, Comstock looks very, very good. EQT and Range Resources also have outstanding hedges in place this year, which keeps them cash flow positive. They did a really good job. Antero does not. Antero has very little of their gas hedged. Now, they do produce a high percentage of their production, like 30%, is natural gas liquids, NGLs, and that price has increased. NGL prices have really bounced back. A little pullback now, seasonality, but it's much higher than it was. And what's happened to the NGL market in the U.S., the NGL market now has a lot more export capacity than it had a year ago. There's been a lot more ships to haul it and everything. There's huge demand for propane, butane, and stuff in other countries in South America, in Asia. We're shipping, propane over there, and we have a huge petrochemical business that produces a lot of this stuff. So, again, it's great. But when we get the export capacity ramped up for LNG, it's really going to help gas prices. I mean, we're looking at in 12 months. Just LNG export capacity is going to go up by 6 BCF a day. That pretty much wipes out the surplus of demand, of supply over demand right now would be totally wiped out just when the next 2 export facilities get put online.
Do you think those projections for like 2030 of all the liquefied natural gas export facilities that are under construction, and how the U.S. Liquefied natural gas export amounts could I don't know, about double. It's an enormous increase. Do you think that that projection is going to be true? Or do you think that politically, there's a lot of politicians and bureaucrats that are going to sabotage those new liquefied natural gas export facilities that are at the permitting or early construction phase?
Well, the next 3 or 4 to come online, they are all fully approved. They're moving forward. It's only the ones after 2025 that are subject to that Joe Biden, pause and approvals or whatever. I will tell you right now that if Trump gets elected, he is going to fast track this LNG stuff like crazy because he knows how important it is to the U.S. economy, the job growth, just our trade, balance is so important, and the way to do it is through LNG exports, and it'll increase our utility bills a little bit, but not that much, and it will probably help our trade balance is so much more, and it's important.
I want to ask you now about the ExxonMobil acquisition of Pioneer Natural Resources for around $60 billion that just went through. I think we've had over $200 billion in mergers and acquisitions the last 18 months or so. A lot of them are U.S. companies in the shale oil field. There's been a smaller amount in Canada. Do you expect this trend to continue even with higher interest rates?
Yeah, you're running out of targets, quality targets. So you got Pioneer going into Exxon, and then you got Diamondback, Endeavor, and I love that deal. I tell you what, when that Diamondback merger closes, and it's going to close by the end of this year, I think Diamondback is a more valuable company than Pioneer because they have better acreage. They are one of the low-cost producers in the Permian. The Wall Street gang loves them because they give really good, detailed, guidance every quarter. They're running 16, 18 rigs all the time, very active, and they've got, strong production growth locked in. But this merger with Endeavor, they literally are their offices are right across the street from each other in Midland. And, they probably go to lunch with these guys all the time. And so they decided to merge the companies because the founder of Endeavor is getting up in age. And I think he just wanted to, make a big deal, his big hurrah. And anyway, it's going to be a first-class company. So it's constantly being listed as a strong buy by all the energy analysts that follow it. So the symbol is FANG, F-A-N-G, and it's Diamondback Energy.
Yeah, a lot of the mid-tier ones, independents in the Permian, have been bought out the last 5 years. You have like Parsley Energy, Cimarex, Pioneer. I mean, there's not many left. So either ExxonMobil or EOG or Diamondback have bought a lot of them.
Yep. One I like that I think would be a good target would be Permian Resources. They just closed in November. They closed a merger with Earthstone Energy, which is one of my favorite companies. So one of my top picks in our Sweet 16 was, and so is Permian Resources. So you had the merger of two of my top picks, and I love that merger. And they've already, they took it over in November, and their first quarter results, they've already lowered the completed well cost. They've increased the initial production on the new wells that they've completed on the Earthstone acreage. They're very bullish on the deal, and they think it's going to generate, much more than they, dealed when they made, much more profits for them than when they made the deal in the first place. So it's a very bullish situation, and they are up there. They're with about 300,000 BOE per day, most of it oil. And they have a lot of running room. I mean, it has a lot of acreage, and they hold a lot of the tier 1 acreage in the Delaware Basin is owned by Permian Resources. There's some other pure plays. Vital Energy is a pure play on the Permian. Who else is in there? Let's see. Matador Resources, I also think would be a real target. It's got a little bit of production in the Eagle Ford, but it's 90% Permian Basin. And I think it would be a great target for somebody. SM Energy is looking really good in the Permian Basin. Also, they made a big comeback. It's one of my better picks for this year.
And in terms of valuation, I mean, a lot of these oil producers, their balance sheets are very clean. Some of them, this is the cleanest their balance sheets have ever been. They paid down a lot of debt. They're focusing on profit margins and free cash flow. I just saw an article on oilprice.com this week saying that like the oil companies, they don't want debt, they don't need debt, they have cash flow, and they're looking either at buying back shares with free cash flow, increasing dividends, or doing acquisitions.
Yeah, I love the discipline that's happened. If there's one thing that came good out of the pandemic, it was these guys got the religion or something, and they have focused on generating cash flow, paying dividends. Like you said, I'll bet you of the 16 companies in my Sweet 16, at least 10 of them have got significant stock buyback programs underway. So they're maybe paying out like 50% of their free cash flow is being paid out of dividends, and the other 50%, now that they've gotten their balance sheet in shape, is going to buy back their shares. And some of them, I mean, it's decent percentage. A lot of in the past, I never did like stock buybacks because it seemed like, okay, you're buying back some shares, but you're immediately giving it out as as stock bonuses and stuff. So it never seemed to lower their outstanding shares. But some of these are pretty substantial stock buyback programs that really make a difference in my valuation as you go out a few years. So.
Well, it depends how disciplined management is, if they're
Yep.
using free cash flow for the share buybacks or if they're using debt, because there's a lot of companies in the S&P 500 and other industries that used a lot of debt for their share buybacks because the interest rates on the debt were artificially cheap. And then they were indiscriminately, and you see this with a lot of big tech companies, they do indiscriminate amounts of share buybacks. I think Apple just announced a record one. I think it's like over $110 billion worth of share buybacks. They're not picking and choosing valuation or using free cash flow. They're using debt for share buybacks at a high valuation already.
Yeah, that was a mistake. But they saw such cheap money. I mean, the interest rates were so low, it was like cheap money. We're going to use it, buy back our energy. They thought their stock was really cheap, so they're buying it back. But I don't think using debt to buy back stock is a good idea. But if you got you're generating a ton of free cash flow, what the heck, start buying it back. But I love the payment of dividends. Some of the companies that are in our high yield income portfolio, the yields are like 8-10%. I mean, it's really incredible what some of these companies are paying out. If you're looking for dividends, I'll tell you this Civitas Resources, CIVI, it pays a fixed plus variable dividend. When you add them together, it's like a 9-10% dividend yield. And the company's growing, it's increasing the production, but boy, it's a cash flow machine. And like you said, the management of some of these smaller caps, because these guys were up against it. Some of them were looking at bankruptcy back in the early days of the pandemic. And when things got turned around, they just said, I'm getting away from you. I'm going to pay off all my debt. So some of my really small cap companies have now paid off all their debt. They're virtually debt free. They don't have any interest bearing debt. Their only debt is like trade payables, which everybody always has but they have, their current assets exceed their current liabilities, and they have no long-term liabilities. So these companies are insanely strong balance sheets now, paying dividends, growing production, and they look real good. Hey, and one thing I'll mention is since that Mountain Valley Pipeline came online, taking oil from Alberta, Western Canada to the West Coast for export, the differentials on Canadian oil have just dropped like crazy. I talked to the CEO of Hemisphere Energy, and he told me between his March oil price and his April oil price, he's getting an increase of $14 a barrel, with most of it coming from the differential that's been a result of the Trans Mountain Pipeline coming online. So look at some of these Canadians; they're going to have really strong second quarter results.
Yeah, you have that pipeline that's going to the Canadian coast, I think to British Columbia. Mm-hmm. And a lot of that oil, I used to be an oil analyst, the Western Canadian Select, it used to sell, I think, almost $20 a barrel discount to US oil because of all the extra transportation costs, and that oil was considered landlocked. Well, if they build that pipeline out and they can get it to the coast, that huge discount of the Western Canadian Select oil is going to be, that discount's going to start to erode.
Yeah, we had the CEO of In Play Oil in Houston a couple of weeks ago to host one of our luncheons, and he predicted that he thought the differential might go to zero this summer because the heavy oil companies, they're moving their oil to the Trans Mountain Pipeline to get better prices on the West Coast, and they're taking it off of the pipelines that they are using in southern Alberta and southern Saskatchewan So it's opening those pipelines into the U.S. for those companies, so that they're going to get much better netbacks on their gas, on their oil price.
But I would argue in terms of valuation for different companies in different sectors that the oil and natural gas industry producers, so these are the ones that are producing, that have cash flow, profit margin, stuff like that. In terms of valuation, they are some of the cheapest of any companies in any sector. And I think that's why we're starting to see some of the really big name investors, either value investors or global macro hedge fund managers that do asset rotation. They're selling their technology companies like NVIDIA stock, Amazon, Apple, and like money managers like Warren Buffett. They're starting to load into a lot into Occidental Petroleum. David Einhorn, head global macro hedge fund manager, he's been buying base metal miner Tech, which also has, or unless they sold the coal production, I can't remember if they sold all the coal or not. But he also is buying Southwestern Energy Company, a undervalued natural gas producer that Chesapeake has been rumored to buy, and Stanley Druckenmiller is doing similar asset rotation strategies too.
Oh yeah, if you look at some of these companies, and especially the ones that pay big dividends, they're trading at PE ratios under 10. and they have growth and strong balance sheets and everything. And then you compare it to some of these tech companies that are trading at 50, 60 PE ratios. But I was just looking here. I've updated all but one of my forecast models for the Sweet 16, and the average PE ratio of the group, and these are quality companies, is 8.7 PE ratio, single digit PE ratio. And these are all super high quality companies in the portfolio.
Yeah, and the weighting in the S&P 500 oil and energy companies, it's down enormously compared to 10, 15, 20 years ago, even though they have way higher earnings than a lot of other companies in a lot of other sectors. You just have a higher multiple on the revenues, the sales, the earnings for the big tech companies. But I think what the market doesn't understand yet, and you're starting to see some big name investors. There was a book we were talking about before we started recording from Lawrence McDonald, and he mentions this in extensive detail in the book, that these big large cap tech companies, so Microsoft, Google, Amazon, those guys, the ones that are all saying, oh, we want to do artificial intelligence, oh, we want to do all these next generation technologies, it's not cheap software anymore. The next stage of growth for them, and Mark Zuckerberg of Meta has talked about this in podcasts recently, they want to build out these insanely advanced, insanely expensive data centers that could cause like an order of magnitude for electricity usage.
Yeah. It's there's a lot that's have to change for that stuff. The AI craze is great, but if you don't have the energy to run it, then the electricity to run it, then how great is it? And do you want to hook your factory up to AI if the AI data center has a brownout or blackout or something, and it shuts down your entire business? So it's I don't know. I don't know enough about it to talk intelligently about it, but it sure seems like a big jump in electricity demand.
Well, also you're taking a much higher capex. So Microsoft making software, say like with Microsoft Office, their capex bill to build new software like that is very, very cheap. But if they want to build $100 billion data center, they have to maintain all the property, plant, and equipment. All the cheap electricity has to be sourced from a power plant. Like you said, I mean, those are way higher costs than them just coming up with new software updates, which is why those technology companies, sold at such high multiples, was the software that these companies or websites that these companies were coming up with for advertising revenue. They didn't have high capex, but now it looks like their next phase of growth with the new technologies, it's all going to require enormous investment in capex, maintenance capex.
Yeah, but I just wonder if the utility companies will be making that investment. I don't know. I don't see
or Microsoft or Meta get the government to pay, because I think I just saw wasn't Joe Biden, he was in Wisconsin and he said he's giving Microsoft like a couple $1 billion to build a data center there in Wisconsin next to a trade school.
Yeah, and that's a company with a mountain of cash sitting on their balance sheet, and their government's going to give them money. I mean, it's crazy.
Well, they need to buy votes in a swing state.
Yeah, they got to buy votes. So.
In a swing state, which is a coin flip.
Yeah.
So unfortunately, this is a new normal we have, but I think there's a large investment opportunity, like Dan was saying, in investing in this electricity demand growth trend because of all the new technology. So like electric vehicles, Bitcoin mining, data centers for artificial intelligence, or the metaverse. All these things are going to require an absolutely enormous amount of baseload electricity that the market has not figured out yet.
Yep, that's right. So anyway, we live in interesting times. This is it's the transition in energy. When you think about it, it's not really a transition to wind and solar. It's a transition to electricity, but the electricity has to have reliable fuel. It can't be when the wind's blowing or when the sun's shining. It's got to be reliable or it won't work. You can't run an economy on unreliable energy. So I think historians are going to look back on this period and they're going to question, what were these idiots thinking that windmills is going to be an answer to your energy solution? Or, so solar makes more sense to me, but the whole windmill thing to me seems like crazy.
It's corruption. It's the energy spending grift, because now we're seeing that a lot of these electric vehicle companies, other than Tesla Motors, a lot of these other ones are close to bankruptcy. Ford, the numbers are just coming out in the last month or so. Ford is losing over $100,000 per electric vehicle they manufacture. I mean, that's not sustainable for them. So you're looking at bankruptcy or bailouts for a lot of these green energy, solar, wind, biofuels, electric vehicle companies now. Bankruptcy or bailouts.
We got to get more intelligence in our energy policy. That's what we have to have.
Well, if you're Microsoft and you're going to build $100 billion data center for next generation, and the property, plant, equipment maintenance, you need stable, cheap electricity baseload. So you need natural gas or coal or nuclear power. And there's articles coming out in Northern Virginia, like from a lot of the mainstream media, from Washington Post and elsewhere, talking about this problem. They estimated that Northern Virginia, because we have the most data centers here, we need another 2 nuclear power plants installed to handle all the data centers we have now and the ones under construction.
Yep. And it takes a lot of diesel to build that stuff too. So it's really, in the short term, is going to create a massive increase in demand for fossil fuels. Really, I think the way to look at the U.S. natural gas market is, okay, we got the surplus of gas in storage because of 2 mild winters in a row. Now we got the weather changing because El Nino's going away and La Nina's coming. Okay, so that's going to change the weather pattern. I don't know what that means really, but then the near term on the demand side is these 3 big LNG export facilities coming online. A 6 BCF increase in demand is like a 5-6% increase in our demand. That's a big deal on a supply chain that runs kind of on marginal supply and demand when you hit that much demand hitting it at one time. And then right behind that, or at the same time, we're going to have to be building all these natural gas fired power plants. So so if you go look at the NYMEX strip, if anybody go look at the NYMEX strip, you're going to see that the gas prices on the strip are like more than double. If you go a year and a half out on the NYMEX strip to the second half of 2025, the end of 2025, and then into 2026, look at the strip. You're looking at $4 strip prices. You could lock that in right now. So everybody says, we got to get back to $3 for these gas companies. They could lock in $4 prices for the next couple of years if they wanted to. Just go out on the strip and do it with swaps.
That's interesting. So you think the odds are pretty high that over the next couple of years, natural gas will be headed back towards 4?
Yeah. Well, I tell you, the futures market's telling us that. And I would tell you, either Raymond James, I met with their top energy guys here, and before the last mild winter, it kind of ruined their forecast. Their forecast was that by 2025, natural gas would be over $5. That was kind of their official forecast. And because of the mild winter, it's been put, because in the mid 2022, we had $9 gas. We had spikes to $9 gas. So it can happen. And if you think the price of oil is wildly volatile, run a 25-year chart of natural gas prices, and you'll see volatility that'll be 3 times as much as the oil market.
Well, also,
and it's low. It can't go much lower because they can't survive below 2 for very long. So we need higher gas prices just for the companies to be able to survive.
Well, I'd say the natural gas market has changed a lot since 2008. I mean, prior to 2008, the U.S. really didn't have a liquefied natural gas export market. And now we're number 1 with how much capacity we've installed with Cheniere Energy and the other liquefied natural gas export facilities. And the projections are even more than that. So we did not have a global natural gas export market for the most part prior to 2008. And just in the last 15 years, the market has changed a lot.
Oh, it changed a lot. And we're building pipelines into Mexico. we're now exporting about 8 BCF a day of gas into Mexico, and I think there's got additional pipelines are being considered.
So as we wrap up here, I want to ask you about the gold to oil ratio, because you sent me over a chart, and I've seen also Tavi Costa, my friend, who global macro hedge fund manager, Crescott Capital. He puts out great charts. He's a must follow over on financial Twitter. And he was showing that in terms of the gold to oil ratio, he's showing that this is the oil prices very relatively cheap versus gold, that normally the oil price rallies. Do you expect that to happen in the not too distant future too?
Yeah, if you look at the historical relationship, oil should trade for 1/20th the price of gold. So if gold is at 2,300 now, take 1/20th of that, and you're at over $100 barrel oil. We should be over $100 barrel oil now, and they don't call it black gold for no reason. They're both, gold and oil are two of the highest traded commodities, and they're both seen as storage of value, that they have future value. And so once we get past this paradigm that we're going to stop needing oil anytime soon, which is insane, then you're going to see that go back. And that article that I sent you said that I think there's like an 18 or 19 month forward. So you can look out. So if when did the gold price go up, like start this run up? And it was 18, 19 months ago. And he's saying that by June or July, we should see oil follow that same path. And I'm also seeing that supply and demand is going to really tighten up in June, that they think this little temporary pullback in oil is just a very temporary thing.
Well, let me say that in a free market, I think you'd be right, and we would start to get an oil rally. However, we have the November election coming up, and with the way the things work now in the White House of the Biden administration, I think they have no issues emptying the Strategic Petroleum Reserve a lot more, or having Wall Street bankers that are friends with the administration operate as a plunge protection team to smash the futures contracts. Anything there, we have people in power now in DC that are willing to do either anything or almost anything to manipulate a certain market in the short term for a political outcome or to buy votes.
Yeah, it doesn't surprise me at all. It's you can't hardly understand half the stuff they do. So might be doing that too.
Well, if they keep oil prices too artificially low, I mean, with all the inflation and the other governments noticing things happening, I mean, you're going to start to see other governments like China start to stockpile more oil, and then there won't be the investment into more oil supply if oil prices stay at these levels. So, yeah, in the short term, if they can keep oil prices in a range for the November elections, that's good for the politicians in DC, the incumbents, but then that probably means higher prices for us later on.
Yeah, it does for sure, because the problem we have now is that because of the underinvestment in new oil supplies, and through the rest of this decade, the global oil market looks very, very tight. It's like I told you at the beginning, our crude oil, our gasoline, and our diesel inventories are all below the 5-year average for this time of year. We're entering the high demand period for transportation fuels, and gasoline and diesel inventories are below normal.
Well, the other thing long term that most people, it's shocking, aren't aware of is that if you go back and look at the oil production growth over the last 15 years, 85% of it's from the Permian Basin. That's for the entire planet.
Oh, yeah.
That's
the entire world. Yeah. It used to be before the Macondo blowout that the Gulf of Mexico was responsible for about 50% of global oil production growth. Well, now it's the Permian Basin, but we are running out of high quality acreage there. The Bakken's on decline. You got Eagle Ford probably has passed its peak, and so the only big U.S. basin that's got a lot of upside is the Permian. Now that doesn't mean that some of these companies that are in the Eagle Ford or the Bakken are not great investments. They are. They still have individual companies that own some good stuff and have a lot of running room. But the Permian Basin gets a lot of the attention, and it's definitely the source of all of our upside. Right now is coming from the Permian Basin.
But I think long term, the future oil production growth is going to have to come from deep water. So it's going to have to be in Guyana or Suriname or Eastern or Western Africa off deep water offshore and Brazil, because I don't see a lot of other oil production growth. I mean, I guess you have 500,000 barrels per day out of Argentina, but that's a drop in the bucket compared to the Permian Basin.
Oh, yeah. Our production is now like 13 million barrels a day. But I don't see it going a lot higher. I don't see our production going above 14 million barrels a day. So I think we're nearing the peak.
And
Because more and more wells, these are high decline rate wells, these horizontal shale wells. And so every year you have to drill more and more of them. And we're not running enough rigs. Our active rig count is not high enough to increase our oil production.
and how much of that 13 million or a little above 13 million barrels per day does the Permian Basin account for?
Oh, it's like 8. It's way more than half of our production comes to the Permian Basin.
So basically, once that major field starts to decline permanently, and yeah, there's a lot of drilling in new wells, but once it goes into permanent decline, we're looking at higher price floors for oil, I would say.
Yeah, you have to just then have higher and higher prices. The reason we're at 80 now is because the cheap oil's gone. There's very few areas that can make money with $50 oil, so you will never see $50 oil again. So it's just we keep raising the floor price that you have to make money. They're doing a really good job now, and one of the things that's really benefited from a lower active rig count is the rig rate has come down. The cost of tubulars have come down, so the completed and oil field service rates have come down a little bit. So the well level economics at like say $75 oil are probably as good as they were last year at $85 oil. So
But isn't that cyclical though, right? So like the oil
yeah, it
service
is.
companies on the way up, they start to renegotiate and want to charge higher
Right.
prices though. So that those temporary price cuts, the oil service companies are just giving discounts to get some business. They're going to start charging higher prices if oil does start to rally.
Yeah, but also I think there's more discipline in the upstream companies. They're not going to go out. They're not outspending their cash flow, so they're very disciplined. Their boards and their stockholders, their big stockholders, want those dividends, so they're not going to do it. I don't think. Another thing I get is, oh, if Trump gets elected, it's going to be drill, baby, drill, and we'll do all this. That's not going to happen. That's just not going to happen overnight. There may be a little uptick in approvals for LNG export facilities or pipelines and stuff like that. But as far as the upstream companies going out and just spending like crazy on drilling new wells, I think they've learned their lesson.
Well,
It won't happen overnight, even if he mandated it or something.
Well, even if Trump approved a lot of nuclear power plants, I mean, it would take way over 10 years. And the nuclear power plants that are under construction now and close to finishing, they're not on time, not on budget. I think like the one in Georgia that's close to being done, I think it was budgeted around 12 billion, and I think it came in at over 30 billion.
God, yeah, crazy. Those are big numbers.
Well, I guess if they're going to print the money and hand it out, because that seems to be a lot of the energy policy here, is whoever's in control of Congress or the White House, they all have their pet projects for what type of energy, and this is the problem with the United States. There's a lack of free markets, and then when the politicians are in power, there's no consistent energy policy, so it changes like every 2 to 4 years by who controls Congress and who controls the White House.
Yeah. The only thing consistent is we're going to need fossil fuels for a long time, and they're going to be providing about 80% or 90% of the world's energy needs for the rest of my lifetime. I know that.
Well, don't tell the Davos crowd that. I mean, like China and India are loading up. China's building more strategic petroleum reserves, stockpiling oil, importing enormous amounts of coal. I think like the news stories that I've seen recently in the last month or so, India actually has the fastest growing electricity demand. It's really shocking people, but China's upgrading their electrical grid. They're installing clean coal scrubbers, and they're going to be building out those data centers too. So their electricity demand is going to be absolutely enormous going forward too.
Yeah, it's going to be crazy. And there really is not enough talk about India. Don't you? You always hear about China. What's going on with the Chinese economy? You hardly hear anybody talking about the Indian economy.
India,
and they're a huge energy demand country.
Exactly, they are. And so they have infrastructure increases. I think India just imported a record amount of copper. So China stockpiled a lot of copper the last 3 to 5 months. I think it was almost as much as their entire 2023 imports. So global copper demand actually shockingly increased on a net amount, especially out of China when most people thought it would collapse. And then India is importing copper, and India is building a lot of power plants, nuclear and coal. And so Indian coal demand, their electricity usage is going through the roof. I think some of that might be factories are moving to India, but also like it looks like their government's investing in electrification and infrastructure grid upgrades too.
Yeah, the outlook for copper has got to be very good because there's no substitute for copper. You can transmit electricity with aluminum wires over distances. But I think for houses and the business itself, for the end users, it's all got to be copper wiring. So I think there's a lot of future there on the copper companies as well.
And I would much rather own copper over the next 10 years, copper plays, than long-term U.S. Treasury bills and TLT, because I think the government's going to be inflating away the debt. And I think the grades for the copper, the cost for the copper is going to keep rising going forward. There's looks like a lot of demand based on new technologies and electricity usage, all these data centers, Bitcoin mining, electric vehicles, and the grades for these copper mines. I mean, a mediocre, medium-sized copper mine, it's over $1 billion to build it, and it could take 10 to 12 years.
Yeah, it's just like in the oil business, the cheap copper has already been harvested. The stuff near the surface is harvested. You're going to have to go deeper and deeper. You're going to have to go to less quality ore, right? I mean, that's just
it's even worse. It's actually even worse than oil and natural gas. For the metals, like we could talk about this like in a whole separate podcast. I could talk about grades for copper and silver. I mean, a lot of copper mines, the percentage of the ore grade in a ton of rock for copper is like 1%.
Oh, wow.
So out of 2,000 pounds of mostly worthless rock, there's about 1% copper. That's how bad the grades are. We're literally scraping the bottom of the barrel. I want to thank you so much for your time today, Dan. If my listeners want to check out Energy Prospectus Group or look at your two model portfolios, the Sweet 16 or the income generating portfolio, how do they do so?
We're a subscription service, so it costs $350 a year to be a member, and that's for a year. And we have a monthly newsletter with these three model portfolios in it, but we also publish every quarter. We publish updated profiles, detailed profiles, and detailed forecast models that are Excel. You can download them to your own computer and play with the assumptions in the models. If you want to see, how low can I take the oil price when this thing to make this thing still break even? I get that question all the time, and all you have to do is change the assumptions in the models. So we give you the tools. I basically say what we do is we do the due diligence that people should be doing before they invest, and we give you the tools to do your own due diligence. But we do have these three model portfolios. We don't handle anybody's money or anything, so it's just a subscription service. And you can go to Energy Prospectus, send an email to energyprospectus@gmail.com if you're interested, or just go to our website. That's www.energyprospectus.com, and you can join through the website.